Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Ed Lopez. He's the head of ETF product over at VanEck, and we're going to look at business development companies. Ed, thank you so much for joining us at MarketSite today. So tell us a little bit about what BDCs are.
BDCs are essentially a form of closed-end funds that finance and provide managerial assistance to small and medium-sized companies. Really, the companies driving the private sector growth for the U.S. What's also cool about them is many of them are publicly traded, which means that regular investors can access investment opportunities in private companies. You'd otherwise have to be a very wealthy investor to go into private equity or venture cap. So it really helps democratize access to those type of opportunities.
So what have recent regulations, how have they been beneficial for BDCs?
Well, the tax reduction at the end of the year was beneficial for small business owners. Hopefully that would mean that they would reinvest in their business, and anything that helps their business makes them a better credit to the BDCs. But most recently, on March 22nd, the Congress and the administration passed into law the Small Business Credit Availability Act, which, among other things, allowed BDCs to increase the amount of leverage that they use. So up until this point, they were limited to 1-to-1 debt to equity in terms of leverage. Now that goes to 2-to-1. And what many of the BDCs, typically the bigger ones now that have gone and gotten board approval to go ahead and start to implement that, what they plan to do is take on incrementally more leverage, not up to the 2, maybe to 1.25 level, and reallocate that to their higher quality investments. So they claim that it'll help their book of investments. They can increase returns to investors, and they have a wider buffer of which to manage their leverage against the leverage limit.
All right, so are there any headwinds that BDC stock prices face, like rising interest rates or?
So BDCs, they kind of ride the fence between the closed-end fund and a publicly traded company. So they are an equity for all intents and purposes as well. So they will trade in sympathy with equities, but 80 to 90% of the investments that BDCs make are floating rate. So as interest rates rise, they should see their income increase, and their cost of financing is usually done at a fixed rate. So as that spread widens, they should be able to earn more. So they can be very resilient in a rising rate environment. Headline risk, when the Fed increases rates, they might see on a day-to-day basis trade down, but with their book of business and investments, they can be fairly resilient against rising interest rates.
All right, and to wrap it up, let's talk about VanEck's product, BIZD. BIZD.
Yes. BIZD is our ETF on it. It's if you were to screen for it, it'd probably screen for the most expensive ETF that there is if you just look at it on the surface. But what you really have to pay attention to is why that is. At the surface, the net expense ratio is 9.67%, but most of that is SEC mandated indirect fees. What happens is the SEC a while back said that funds of funds have to provide disclosure of total costs. That means direct costs like the management fee that VanEck earns and other operating expenses, plus the indirect cost of investing in underlying funds. Since business development companies are technically a closed-end fund, we have to disclose what that expense ratio is. But they're also just an operating company. They have payroll, real estate taxes, other operating expenses. And so when you add that up, it ends up with looking like a really big expense ratio.
Right.
But that all gets valued into their share price, and it's not a direct cost that investors actually have to pay. At the end of the day, investors will pay VanEck 40 basis points for managing that fund.
All right. Well, thank you very much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.